happening with this EBITDA?
EBITDA, okay. All right, since you are back now, Aisha, are you on the call?
I am now on the call.
Okay. And namesake, are you there too? It's like my namesake is sleeping. Okay. So let me go back to the EBITDA again. So the EBITDA is quite a simple ratio, but it's a bit complicated. So let me go back again for clarity's sake and for Salman that was off and on. So the earnings before interest, the first earnings that we'll look at from our case here is the profit before depreciation and amortization. Julie can say, why didn't we just pick this depreciation and amortization? You won't do that because you want to understand the deductions and the additions, especially where you have finance income. If there was no finance income in this place, we will not do all the journey of working back, deduct, deduct, deduct. We'll just come to 132 and pick it as our EBITDA. But because we want to understand all these expenses that are not directly incurred in the business, they were imposed on the business, like depreciation and amortization is imposed. You must deduct it because of an IFRS provision or a company policy. Finance cost, you borrowed money, so you must pay back. Tax is money to the government, you must pay. But you see, these ones can be influenced. Admin and distribution, your cost of sales can also be influenced by your decisions. So your decision cannot influence depreciation, finance cost, finance income. That one, you borrowed money, you got a return from somebody owing you. So the EBITDA is trying to measure the direct operational efficiency and cash flow generation of the business, excluding any effects of financing, government, and non-cash item or non-cash movements. So that's what it's all about. So I started the calculation by saying that I'll add back my profit after tax. I'll pick profit after tax as the first item. Then I'll add back tax expenses, add back finance cost, add back depreciation, all the costs that I have no control over, I'll add them back. So immediately I add them back, I will have a total that is, in fact, let me even do a total here of all the expenses before I deduct. So I have 143,000. So this 143,000 now is like we even computed, my formula was wrong. So 143 is what I got after adding back all the inorganic expenses. So I now want to remove finance income because that is an income. We can't add it back. So our finance income 43 minus 11 is now going to give us 32. So if you come back here, you can see that it aligns directly with this profit before depreciation and amortization, even after we have removed finance income. So this 132 aligns practically with your EBITDA, that this is your earnings before interest, taxes, and depreciation. But sometimes the examiner may not give you this figure, and at times he may give you and say this is EBITDA, so you don't need to stress yourself, just pick the figure. But we're in a situation where I pinned it now and I call it profit before depreciation and amortization. Please add back, work back. Pick your profit before tax, add finance cost, add depreciation, then remove finance income if there is, to arrive at your earnings before interest and tax. So do we understand that?
Okay.
Julie doesn't understand. The way she said, okay.
Okay.
So why can't we just pick the 132 directly? Why do you have to add that?
Exactly.
You see? So
instead of doing all the sufferings, we can look at all the items there and say, okay, these are things that we add back. Since we already have the figure, we might as well pick it up. So
exactly. So under exam condition, if you are sharp enough because of time management and you know 32 is correct, fine. But to be very sure, so that your interpretation and your explanation will not be wrong, please walk back. work back. But if you can pick 132 and you are clearly sure it is, it's fine. You've saved a lot of time. I'm going through this process so that you can understand the cost components. That's just why I'm letting you follow through. All right. So it's fine. So let's go now. We have overflogged this EBITDA. So let me pick my revenue so that we can move on. So revenue is 132. Oh, okay, I already have the figure here, so let me just post it here. Okay, so 132 billion. So what is our EBITDA profit ratio, or it's called EBITDA profit, okay, or EBITDA margin? Any of these two you call it is correct. So I think it's 10%.
10% for both, for all 23 years.
Oh, fantastic. So that means their operating margin is 10%, 10%, 10%. Their EBITDA is also 10%, 10%, 10%. Wow. So operating profit, EBITDA margin, they have the same computation, the same values. Fantastic. Okay, so 10%, 10%, steep plateau. So the question now is, what is the difference between EBITDA and operating profit margin? So the difference is that EBITDA, you have to add back, while operating profit margin, you don't have to add back. So under exam scenarios,
EBITDA considers non-cash transactions.
Exactly, Salman, exactly. While operating profit considers only cash transactions. So under exam conditions, just take note of both ratios. They are not the same. Even if we have the same result currently in the computation, they are not the same. So let's look at the meaning so that it will give us more context, the implication. So a higher EBITDA margin indicates that the company is generating strong core profits relative to its revenue, demonstrating operational efficiency and good control over its core business, not non-core. A lower EBITDA margin suggests operational inefficiencies or high cost in limiting the company's profitability. It may be an indication that the company is struggling to manage its operating expenses, or that revenue are not being maximized. So this may be the reason for a low EBITDA. Now the cause and effect. A higher EBITDA margin shows either strong revenue growth combined with effective cost control. Operational efficiencies that reduce costs related to production. So we're looking at direct cost, then indirect, admin, and selling. So the absence of non-large or large non-cash charges, depreciation, amortization may also boost EBITDA. So look at where this comes in now, Julie. You see the adding back of this depreciation and amortization will help boost it if the depreciation and amortization is not large. Yes. So look at what they said. It may boost EBITDA in asset-light business. So where the assets don't have high depreciation or they are not capital intensive, your EBITDA is always positive and has a positive outlook or result. So take note of that. While a lower one signals rising operational costs, the same direct labor, material, utility, without corresponding revenue growth. So this could be the challenge. While declining revenue in a highly competitive or difficult market environment, the need for significant spending on operating expenses like marketing, research and development, logistics. So where you have revenue declining, they need to expand. They need to work on doing research and coming up with new product lines or services that will boost their revenue. What are the effects? The EBITDA or a high one indicates strong cash flow because your direct or core operations brings you direct cash from revenue to direct and to indirect costs before the costs that you don't have control over, making it easier to cover interest expense, taxes, and capital expenditure. So when you have a high operating profit, a high EBITDA, it shows that, man, you are doing very well and you could cover most of these uncontrollable costs, or we call them inevitable costs you have no control over. And it can also increase investor confidence and suggest effective operations and robust profitability. The company may have more flexibility for expansion, reinvestments, and paying of dividend when they have a high EBITDA. While a lower EBITDA raises concerns about operational inefficiencies, rising costs. It can indicate reduced profitability, making it hard to cover fixed expenses like finance costs and capital investments. So this may cause investors to question the company's ability to sustain long-term growth and profitability. So the EBITDA is actually a long-term measure of profitability, especially in the US. It's a very serious parameter or component to measure performance. So in conclusion, it's a useful tool for assessing a company's core operational performance without the impact of non-operational or non-cash items, which are mainly depreciation and amortization. It is especially valuable for comparing companies within the same industry, as it neutralizes the effects of different financing structures or depreciation policy. So the EBITDA targets the issue of depreciation and finance costs to take them out of the picture. A strong EBITDA margin is a sign of healthy cash flows and good operational management. A declining one indicates inefficiencies or rising costs that needs to be addressed. So that's the EBITDA for you. My CEO in this office, he doesn't play with this ratio. You just ask, what is your EBITDA? What is your EBITDA? He seems to be an American. So even though it's an American ratio, the UK jurisdiction hardly aligns with it. All right, so any question on that? Any question on EBITDA?
From your description of EBITDA, I really don't know why it should be a big measure of measurement. It's a big issue of measurement because finance cost is an issue and it depletes the profit. So that to me, the net income should be the best. The net
Exactly.
should be the best. I don't know why EBITDA should be. But there's so many things involved here. You've removed very sensitive things that affect profit and affect the position of the company and also affect decision making. So why should EBITDA be the ultimate? I don't know.
Yeah, so it may not be the ultimate in the UK. Okay, yeah, go ahead. Let's hear your thoughts. Please speak. Yeah.
I feel because you know that for companies, it's so that it's a management concept where you're supposed to have a mixed source of income where you have debt and equity. So I feel EBITDA is just to measure, to control your debt, so that by the time your finance cost is on the high, you know that you're beginning to put too much money. You're beginning to borrow so much money, or to reduce the payout ratio. Like you're not postponing when to pay your debt. You're paying on time. I don't know. I really don't get this EBITDA. I'm just going with the flow, but I'm trying to make sense of it.
Yeah, so if you look at Julie's thoughts and her where she gravitates towards, I think I agree with her, because if you exclude those expenses you must pay, finance cost, and you are saying it's like the ultimate for the US. In her opinion, it doesn't match. I agree with her argument. But then you see, in a place where you don't even have external debt, you won't pay finance cost. So finance cost is out of your SCI. So like what Salma is of the opinion of is that the mix between equity and debt. So finance cost belongs to interest that you borrowed money from outside. But depreciation, you have no choice. If you have assets, you are running the company, you must make provision for depreciation. It's IFRS compliant. It's a compliance issue. You must comply with that. You can't have assets and say the asset will stay in perpetuity at the same value. It's not possible. Assets based on accounting assumption must depreciate. So the EBITDA, according to the Americans, I think their alignment with EBITDA is that after direct and indirect cost, this is your money. This is the company's money. That's their cash.
Okay.
That's their own argument. And that's why they came up with that ratio. Then every other expense, finance cost, taxes, depreciation and amortization is not your money. You have to deduct it. So the EBITDA shows this is your money. After other expenses, it's not your money. Then the net profit is, okay, they've deducted it. So I also agree with what you said, that the net profit should be the best measure. You have deducted every expense. And that is why the UK IFRS looks at the net profit as the bottom line. That's the best. And that's the last ratio we'll be looking at. So I think it depends on your argument and your debate. And that is why the case study is good. There's no correct and there's no wrong answer. Follow the format, and the examiner will just be marking. And what Julie wrote is different from what Josiah wrote. What Josiah wrote is different from what Salma wrote. And we all pass the exam because everybody's argument is tenable depending on the jurisdiction, depending on the points, and depending on the industry or scenario where the business is based. So that's what I think. It's a good argument in this EBITDA, not net profit conversation.
Okay.
Salma, are you good? Are you good with the explanation? I think Julia aligns.
Yes, I'll take time and read it.
Okay, yes,
If
please.
there's only two of you that are in this class, I'll just take my time and read it.
You two are also in the class now. You're also contributing very, very profitably. Okay, all right, so let's go for the last, which is my best. I think, in my opinion, I prefer the net profit margin. It provides a holistic and true picture of whatever it is that is your own, actually. Okay, so let's go for the net profit margin now, and it's our final profitability ratio. Okay, so this ratio expresses a percentage or the entity's net profit as a percentage of sales or revenue. And the formula is net profit times 100 divided by your revenue. So look at this definition. Net profit margin is one of the most comprehensive profitability ratios. So EBITDA, operating profit margin, has confused you, but this is more comprehensive, and I agree with the study text. It measures the percentage of revenue that remains as net income after all expenses, including operating costs, interest, taxes, and non-operating items like depreciation have been deducted. It shows how effectively a company converts its revenue into actual profit. So EBITDA, in my opinion, is just cash flow. Cash flow is different from profit. Take note of it. Operating profit is different from actual profit. So in my opinion, measure of profitability, the net profit is a more clearer picture. So what does it mean? The net profit margin indicates the overall profitability of the company after accounting for all its expenses, whatever nature of its expenses are. It is a measure of how much the company keeps for every naira of revenue it generates. So from the first naira down to the last expense, tax, it reflects not only operational efficiency, but the impact of financing and tax strategy. So the net income is the profit remaining after all costs, including cost of goods sold, operating expenses, interest, taxes, and other expenses have been deducted. Revenue remains the same. Okay, so I believe it's the simplest ratio we will calculate. It doesn't have any complications like EBITDA, operating profit, and all that. So let's go down to the question and just happily calculate it. All right, so pick our 77, profit after tax.
That's 55.83% across board.
Fantastic. So let me just do one, and I'll just take Julie's calculation and do it across board. You see, it's very simple that she has even calculated everything without like that. NPM is 77 divided
Like
by
Rosie. Return on capital employed.
Yes, those are the complicated ones, and those are the ones the examiner likes to test. PBIT.
Of course.
The examiner likes to test that always. Okay, so you said 5.1%?
5.83%.
Okay, so that's why we have approximately 6%. 2021 too, the same thing, right?
What?
Yes, so good. Salma and
Yes.
Aisha, do you agree with Julie?
Yes, sir.
Okay, fantastic. So we all agree with 6% bottom line. Okay, so in our opinion, is that bottom line low or is high? There was 1%, there was one ratio they still had 6%. Which one? Okay, return on asset, 5. Okay. Okay. So return on asset is 5. The net profit margin is 6. So 5.83% across boards. All right. So let's go for the interpretation and what it means. So the implication is that a high net profit margin suggests a company is effectively converting, yes, we've spoken to that, demonstrating strong cost management across all areas, operations, financing, taxes. So where the figure is positive, I think we need to give management credit. So it just now depends on their improvement. So in this situation where they are static, they are doing 6% every year. The net profit needs to grow because that's the bottom line where you get money to pay preference dividend and also share ordinary ordinary shareholders dividend also. So you should be able to grow that and make it sustainable over time. That's my own outlook in running a business. So you can't be doing 6% of your bottom line. So what will you share to people that have invested capital and wealth into the business? So it's very important that growing your net profit is good. It's essential for a business to be sustainable. A lower net profit margin may indicate expenses, whether operational, internal, external, organic, inorganic. They are having challenges with controlling these costs, wherever it is. So the company should be able to generate enough revenue to cover this expense and still have something to share out to people that have invested their resources in the company. So what are the costs and effects? A higher net profit margin shows that they are effectively curtailing costs, whether it's production, admin, financing, lower tax liabilities, favorable tax strategies, higher pricing power, increased revenue related to costs. While a lower net profit shows there's high cost, whether direct or indirect, that are not offset by revenue growth. So as revenue is growing, the net NPM, net profit, should be growing too, in my opinion. Higher financing costs like interest expense due to increased borrowing, that's debt, increased tax liabilities, and lower tax efficiencies. The effects is that where you have a high net profit, a high bottom line, there's always overall profitability and financial health. Now, the shareholders are interested in net profit because if there are preference dividend, they will give preference dividend because before they will get their own. So dividend and sharing of profit is very essential for ordinary shareholders. While the effects also provides more resources for growth, reinvestment, expansion, returning value to shareholders. I like this because these people are the owners of the business. So returning value to shareholders through dividends or share buybacks. Exactly. It improves their confidence. Also, those that want to invest would have that guts to come and invest since the company is profitable, looking at the bottom line, as it signals strong control over both costs and revenue. While a lower net profit indicates challenges in managing costs and rising competition affecting pricing. It may signal investors, stakeholders that the company has limited profitability, and this is very concerning. It shows that it's not sustainable in the long run. It limits the company's ability to invest in growth, cover fixed expenses, or handle unexpected financial difficulties. So these are the challenges of having a low NPM. So in conclusion, the NPM